Hey everyone, I'm Mickey. Welcome back to LaceUp Solutions, your #1 DSD software. Today I'm going to tell you what each and every single one of the transactions in your accounting system does to your inventory. Whether it be increase or decrease your inventory, this session and this tutorial is designed to help you understand the differences between the transactions and their impact on your inventory. Either way, let's get right into it. Here on the screen, you're going to see that we're working with my item tortilla. Okay? Across the top, I've itemized all of the transactions that you can do in any ERP or accounting system. So we can do a bill, an invoice, a credit, a transfer, or cycle count. Okay? So anyways, let's start with the bill. A bill is an invoice that you have to pay to your vendor because you've ordered product from them and they've delivered product to you. So let's say, for instance, you order 10 tortillas from your vendor, and when they come and drop off that delivery, they deliver 9 tortillas to you. That 9 tortillas is going to go on an invoice in their accounting system. Those 9 tortillas are also going to go on a paper invoice that they're going to hand you, as well as the 9 tortillas physically. So when you receive those 9 tortillas in and you put that bill into your accounting system, the inventory will increase by 9. So that's the effect of the bill, plus 9, and the inventory down here is now currently 9. Okay, so you've got 9 tortillas on inventory. So this is your on hand. That's your on hand inventory. Okay, so now you've received those 9 tortillas into inventory. Now what you're going to do, like any other business, you're going to go out and sell those tortillas. So let's say you go to one of your supermarket chains and you sell 5 tortillas. When you sell these 5 tortillas, you are going to make an invoice for that customer. An invoice is a receivable that goes into your accounting system that your customer will pay you for at some point in the future. So let's say you sold 5 tortillas. So the impact of the invoice is negative. Because you've given the product to the customer, your inventory has decreased. So let's say that your inventory is now 4. So we received 9 from our vendor, we sold 5 to our customer, our inventory is now 4. Now let's say that we've got 4 on hand still, and I go revisit the same customer next week. When I get there, I realize that 2 of the tortillas have gone bad. Let's say the package was maybe damaged. Let's say maybe they were just really close to being expired when I dropped them off. Either way, 2 have gone bad. In most distribution businesses, you have to give the customer credit. Okay? So let's say you're going to give a credit of 2. So now, a credit is always going to increase your inventory. But keep in mind, this is very dangerous, because as your inventory increases, your system is now going to report that you have 6 on hand, when in reality 2 of the ones that you have on hand are going to the trash can. But either way, let me show you what happens. So let's say we have plus 2. My inventory momentarily is going to go to 6. Okay, so we did a bill for 9 that increased my inventory to 9, an invoice for 5 that decreased my inventory to 4, a credit for 2 damaged or 2 spoiled or 2 stale tortillas. My inventory is now 6. In reality, my inventory is 4. Keep this in mind, okay? Because we're going to get to that. Now, let's move on to the next transaction, okay? The next transaction is called a transfer. Now, we'll get into transfers in more details in another tutorial, but a transfer essentially is a transfer of product from one inventory location to another. So for instance, if you transfer product from your main site to your truck, that would be considered a transfer. If you transfer your inventory from your plant in Miami to your plant in Fort Lauderdale, that would be considered a transfer. Either way, we are not going to focus on the transfer for now. We are going to focus on the cycle count. The cycle count is the single most important tool that you can use to edit your inventory. Okay, so remember what happened here? We did a credit for 2 and it increased my inventory to 6. So currently in my accounting system, my inventory is wrong. So what I'm gonna do is, at the end of the week, or at the end of the month, or even at the end of the day, depends how you work, you're gonna do something called a cycle count. A cycle count's when you go out to your warehouse and you physically count the inventory that's in the warehouse. Now when you go count that inventory, what's gonna happen is, you're gonna go, the system says 6, but you're gonna count 4. Okay, so let's say you counted 4. Now what an adjustment does is it edits this value to what you counted, and it applies the difference to some kind of waste or expense account. So the difference in this scenario between 6 and 4 is -2. Okay, so we went from 6, we counted 4, the adjustments for -2. That -2 is going to go to a waste or an expense account. This means that at the end of the year, you can run a report and see exactly how much product was wasted or expensed. Either way, your inventory after your cycle count is back to 4, which is what it was always. Okay? Even though the credit momentarily increased your inventory, the cycle count decreased it. That's why it's so important to do cycle counts. That's one purpose of cycle counts. The second purpose is if your sales reps or your warehouse individuals or your team in the office is stealing from you. By doing cycle counts, you're able to see exactly who's stealing from you and where they're stealing at. So let's do a quick example. Let's take this example. If you would have done this adjustment right away, you would have coded this adjustment, this cycle count, to an expense or credit account, because you know that there were 2 credits here. So basically you just adjusted those 2 credits out. So what I recommend to you is that you adjust out the credits on a daily basis, if that makes sense. Yet you're going to do an additional cycle count every week or every month to see if anybody's stealing from you. That way, if you go do another cycle count a month later, you're supposed to have 4 on hand, but now you count 3. Okay, that means that somebody stole 1. Okay, and that your actual on hand now is 3. So you're able to find out that you have some shrinkage going on in the warehouse because somebody stole 1 tortilla. Either way, I hope that helped you understand the impact of transactions on inventory. If you have any questions, please hit me in the comments down below. My responsibility is to bring you and your company value. Either way, I look forward to seeing you guys next time. Take care.